Hi everyone, welcome back to Risk Biscuits. Thanks for tuning in. Obviously, this is a continuation of a series we started last week. This is interview number 2, speaking with other investors and traders in the market just to get their thoughts and experience and some feedback. So I hope you'll enjoy the show. Just a quick mention, obviously everything on this show is general in nature, all care, no responsibility. Financial advice, go and seek it elsewhere. Also, if you enjoy the show, please like and subscribe. We're a YouTube channel now, so we need to get our numbers up. And without further ado, I'd like to welcome our second guest. So today we've got Alex Cathcart with us. Alex is from Drummond Capital Partners, based in Melbourne, based in Queensland himself. Portfolio manager there, and he'll sort of share some more thoughts around that going forward. Really, without further ado, I'll welcome Alex to the show. Thanks for coming.
No worries. Thanks for having me.
Problem. Now, before we get started, I'll just share my screen. Need to put something up. Just a disclaimer here from Alex and the firm Drummond Capital Partners. You can read through it yourself, but obviously all care, no responsibility. Nothing in show is financial advice. And if you need advice, go elsewhere to seek it. Thanks very much. All right, Alex, welcome to the show. How are you?
I'm good.
Good. Thanks for coming on.
Happy Friday.
Yeah, absolutely. Absolutely. So look, thanks for coming on. Obviously, kind of a new concept that we're just sort of fumbling our way through at the moment. You're our lucky second guest, so thanks for coming on. Really just want to have a general conversation about, obviously investing in the markets and how you interact with the markets and yourself and that sort of thing. So probably a good place to start would just, be at the beginning, sort of, I guess, how you got interested in investing, and sort of what's your origin story in terms of how you came to be who you are in the markets.
Yeah. I don't know. My origin story is probably not too dissimilar from most, other than the fact that when I was very young, I just no real concept of markets or investing. No one in my family would consider themselves really to be an investor or a markets person. Nobody went to university. I was the first person in sort of my broader family to go to university. So I kind of just fell into it, if that makes sense. So I grew up in Toowoomba, went to USQ, which is the sort of regional uni in Toowoomba. Started off with a degree in, I think it was business law and arts, kind of for the want of really anything better, and didn't really know what to do. Law seemed really boring when I started doing the intro subject, but they had I did an economics intro subject as well, and I'd never really done any economics or business before, really. All my high school stuff was science based, basically. But yeah, I found economics quite interesting. And I was like, okay, I'll change to that. Seems pretty good. And then worked my way through that. It was a dual degree, so 4 years, because again, I didn't really want to put myself out there of having to make a decision about what I wanted to do with my life. And then towards the end of the 4-year degree, the sort of economics faculty there were like, oh, do you want to do an honours year in economics? And I was again, yep, that sounds good. Don't have to make a decision, just put things off for another year. So I ended up doing honours in economics at USQ, which was good. I enjoyed my time at uni. It was pretty relaxed life. I was sort of doing uni and just working in various businesses like Macca's and a video store for a while and a pawnbroker for a while and Woolies. So all ticked all the classic kind of boxes. But then finally finished uni and by then I'd figured out that what you need to do is to get a job. So I applied for a bunch of grad positions, wanting to stay in Queensland basically, because my family's there, and my now wife, then girlfriend, has family there as well. So we basically wanted to stay together.
Yeah.
Ended up getting a grad role at Queensland Treasury, or 2 grad positions at Queensland Treasury, which is the Treasury Department of Queensland. One was in the economic sort of macro side of things, and one was in the economic micro side of things, and the macro is more interesting than the micro. So did that, and I liked it. It was pretty interesting work. It's sort of applied forecasting, if that's probably the best way to describe it. It gives you a good introduction to the granularity of, I guess, the economic system. So like how do national accounts work? How do they actually calculate CPI? Like there's a fair bit of depth there, which was interesting and good. But sort of did that for I think about 5 or 6 years, and by the end of it, it was pretty run of the mill, like kind of doing the same thing a lot of the time over and over again. And by that point as well, I obviously had a wider view of the world. Like, so, met other people who had been to university, knew what an investment bank was. I never heard of Goldman Sachs when I was in high school, and then sort of realized that there's this whole other world out there. So decided to sort of pivot and say, well, I want to move to like even more applied economics, I guess, which is investing. So basically, started to try and pivot my way there, and then so ended up getting a job at QSuper, which is now ARC, but that was the sort of Queensland government defined contribution fund, which back when I started, I think it was about 20 bill. Now it's probably 10 times that. But I was there relatively early after they insourced the investment management function there. I think I would have been about the 6th person in the team, maybe. And yeah, started there, and it was great. Like, it was just so much better than just straight macroeconomic forecasting. Like the investment side of things, like there's actually an outcome for what you're trying to do. The people are just much more interested in what they're doing, I think, than just sort of standard forecasting. And it felt like a logical progression as well. So that's basically, how I moved from knowing nothing to just macro forecasting the government to investments. And then I was in the strategy team at QSuper. Did that for 4 or 5 years, and in that team was involved with a fair bit of different stuff, but generally started on the sort of multi-asset positioning side of things, along with some economic forecasting. So basically, what do you want to do from an allocation perspective? And then in the middle period was working on the sort of more quant equity side, so like designing custom index type portfolios to capture factor exposures and to, I guess, be better balanced than market cap indexes, because that was sort of all the rage at the time. And then went back to multi-asset at the end. And then in 2016, I moved down to Melbourne to work with Cbus in their investment strategy team. That was, they're all kind of the same job basically. You're just trying to do allocation, and there was a fair bit of work there around internalizing asset allocation decision making away from the investment committee level to sort of the internal team level, internalizing capital market assumptions, like the modeling, and just building out the team and the functionality there as well. That was really good. And then in very late 2019, I basically just got a cold call from LinkedIn from my current employer, just saying, hey, you want to have a chat? Basically, like they were looking to effectively beef out the asset allocation function, the more sort of quantitative aspects of it. So, had a fair few chats with them, and kind of decided after, how many years, 15 years of working in the kind of not-for-profit, big bureaucracy sectors, I thought it might be nice to try something more nimble and commercial. So took the plunge and started there, and have basically been there ever since.
Yeah, cool. And so tell us a little bit about Drummond and sort of what you do, and obviously you sort of mentioned how you came to start there, but sort of how that role's progressed and what you do in the business day to day.
Yeah, so there's basically the core of our business is running multi-manager, multi-asset managed accounts for independent financial advisory groups. So in practice, what that means is we will build, risk profiled or objective function portfolios. So, 30, 50, 70, 90, 100, 100 plus, or like CPI plus type portfolios made up of a mix of active managers and passive funds or ETFs. And basically, financial advice practices that we partner with will essentially take that as their investment portfolio and put a large part of their client base in that. Say you're a growth investor, you should have a 70 portfolio. Take the Drummond portfolio, your 70 portfolio, and buy that on your platform, which could be Panorama or Netwealth or whatever. And then the way we sort of integrate with those practices is around the comms side of things and the reporting. So we provide monthly blog articles, sort of advisor cheat sheets, FAA papers when we change pitch capital allocations, manager research reports around the managers the active managers that we invest in. So it effectively gives them a package of communication that they can then give to their clients or read themselves to be informed about the portfolios. Are they underweight or overweight different asset classes? Why do you hold this manager? Why did you remove this manager and replace it with this? What sort of equity style bias do you like? So it's sort of just trying to integrate the two businesses as much as possible. So the end goal is for the end clients to have good portfolios, and then for the advisors to be happy with those portfolios and well versed on why they are the way they are, and if they read everything, they'll probably have a good idea about why change is coming down the pipeline, because we're always talking about the outlook and what we can do to try and change things to try and improve the portfolios given the outlook. And from our perspective, we sort of sit mostly in the background and just try and build good portfolios for financial advice firms. We also have a wholesale unit trust, which is sort of similar. The back engine that drives the allocation is similar, but the actual portfolio is quite different. It's made up of securities, derivatives, and basically just off platform. So the unit trust people buy units in it, wholesale investors, and that's effectively a nominal return type product that can be geared. So you can go up to 300 gross total or 150 gross growth. And what we're trying to achieve is over the long term a 10% return with equity-like volatility. So just taking the active stuff we do in the managed account portfolios and effectively gearing it up a little bit to try and generate more return. And that was basically in response to demand from sort of family offices and high net worth clients that we talk to, who kind of often these people have sold a business and they're quite risk seeking, probably a lot more risk seeking than I am, and you tend to have to be that sort of way if you want to start a business and be successful at it. And they look at like a 70-30 portfolio and it's probably just boring compared to what they've done in their life. They're happy to really push the boat out there a little bit more.
Yeah, fair enough. And then so if we talk about the unit trust or the fund, or I guess the business in general, my sense is that you're obviously multi-asset, more systematic in nature. So can you just kind of, I guess, explain what that means for someone that wouldn't understand or hasn't heard the term before, in terms of what you're investing in and what your universe looks like compared to, say, your more traditional, long only equity manager or whatever it might be?
Yeah, so we're like versus like a long only, from a simplest perspective, we will often buy the good versions of those long only equity managers to build a multi-asset portfolio. So with things like equities for the managed account portfolio, we'll probably have between 4 and 8 lines in the portfolio, and some of that's going to be passive. Some of that might be passive targeting a specific sector or is in style or region, but otherwise it's going to be pretty well-known, established global equity managers, because they have to be pretty well-known and established to end up on Australian platform and go through all the DD and the governance that they need to do to get to that point. But we'll blend that again with, for a 70 portfolio, it's going to be global equities managers, going to be blended with Australian equities managers, infrastructure, property, alternatives, and on the defensive side of the portfolio, there's going to be, there'll be some cash and also a mix of sort of fixed income and credit and more defensive type alternative managers and exposures. So it's in terms of, so that's what the portfolio will look like. And it's, to be fair, it's not going to look from a structural perspective that is similar to what the super fund balanced or growth option looks like. They all tend to be multi-manager, multi-asset portfolios. But from going back to the original point about what the process, I guess, looks like in terms of the systematic process, the way these things are constructed, it's basically, we start with an SAA for every risk profiled portfolio. I mean, there's a whole process that goes into the development of that SAA, so we review it every year. But basically what we do is we take a scenario-based approach to the world. So we think of 3 or 4 scenarios that we think are pretty credible, and they're pretty broad type scenarios. So what you would think of like a stagflationary environment as a scenario, or a Goldilocks environment as a scenario, or so something that's pretty easily understandable. Then we develop capital market assumptions for each of those scenarios. There's a fair bit of modelling that goes into that. And then we create effectively, quantitatively optimized portfolios for each scenario. So think of it from the perspective of you have a Goldilocks type scenario, you have capital market assumptions that come with that, so returns and a variance covariance matrix. And then you basically create a max Sharpe ratio optimized portfolio for a 70 growth portfolio, given that set of capital market assumptions, optimized for a variety of constraints. So because the managed account world is all on platform, there's a whole bunch of things that matter from a practical perspective, as in can't be geared, has to add up to 100. Fees are important, so there's fee budgeting considerations. You can't have, from our perspective, you can't have too much in alternatives, just because we don't think, even if you love hedge funds, you're not going to be able to fill up a 70 growth portfolio with 40% hedge funds, because there's not going to be that many good hedge fund managers on the Australian platform, similar with other asset classes. So you go through that process. You create a whole bunch of SAAs for each risk profile in each scenario. And then we basically vote as an investment committee, so the internal portfolio management team and the external advisory committee, on the probability of each scenario happening, create a probability weighted sum, and that ends up roughly being the sort of quantitative version of each SAA, which we then, there's often some qualitative adjustment around that, but that gives us basically a starting point. So that's the SAA. Around that, we do TAA, we call it TAA, other people call it DAA, other people call it strategic tilting, whatever you want to call it. It's just moving the portfolio around to try and make money and reduce risk. But we do that as well. And that's a mix of a quantitative and a qualitative process. So from a quantitative perspective, we have what we call a tactical scorecard, which, again, is going to look pretty similar to what a lot of other people do, which is you have a whole variety of quantitative signals that tell you whether you should be long or short, and how long or short you should be across a different variety of different markets. We're trying to keep things pretty simple from our perspective. So it's not a black box. We're not trying to there's no deep machine learning strategies. It's pretty basic. Is momentum positive? Is sentiment good or bad? What's the growth outlook? What's the policy outlook? We're trying to keep it pretty simple, pretty explainable, but also hopefully repeatable. So there's economic logic behind each of the signals, and then we pair that with a qualitative view of the portfolio management team, which is basically trying to capture the things that you can't quantitatively capture in the model. So that's COVID is a good example of that. It's not in anyone's model, or a break of regime. So most quantitative signals, most market data sort of starts around the 70s, but then if you move to other markets, it sort of becomes the 90s, and it's there's different regimes for markets, and a lot of quantitative models are a fit around a specific regime. So if you think you're changing regimes, you want to be cognizant your models may not work, or your quantitative signals may not work anymore.
Yeah, okay. Yeah,
And
cool.
then, so final aspect of that is filling it up with managers. That's less managers and passive funds, and that's less what I do. So we have an analyst team that basically reviews the managers that they like best that sort of fit in the allocation buckets. But there's only so many hours in the day, so I tend not to get too involved with that process unless it's like a quant manager that I can steal some ideas off, basically. But if it's like a active equities manager, I tend to be too concerned with them, which is probably blasphemy for an investor, but I don't want to hear some PM talk about the best stock picks he's had over the last year, because I know I'm going to hear the winners. He's not going to tell me about the losers. So everyone's pitching their book in this world, right? So yeah,
Exactly.
I'll let the rest of the team deal with that.
Makes sense. So, okay, so then on a more kind of practical note, and maybe it's a question that's better suited for the unit trust than portfolios that you for managed accounts, but happy for you to sort of take it where you want to go with it. Let's assume you get a new mandate, or some sort of windfall that all comes into the business that you've been tasked with managing. It's got no memory, and you're sort of looking to put to work. I guess just at a high level, sort of what's the thought process, and how do you go about sort of getting that capital in the portfolio?
It's probably not the answer that sort of fits the question, but it doesn't really work that way from that perspective for us. Like if you with the managed accounts world, money disclosed in every month, and it gets allocated a lot across the portfolios based on what the advisors put them in. So in managed accounts world, the end user is the beneficial owner of those assets. So they'll log into BD Panorama and they'll see the portfolio, and they'll be the owners of each of the lines in the portfolio. And with the unit trust, we actively manage the flows, so we hit the allocation that we want to hit. So if we get a big because it's wholesale, it's not insto, it's wholesale. But if there are clients who can come in with big chunks of money, we just basically transition manage that with our broker to say when the cash hits, we want to be invested, and everything we're invested in is super big liquid. A lot of global ETFs, like we're not touching the sides of the market in terms of allocation there, so we don't really need to worry about impact from a practical perspective. I mean, the dream is one day you do have to worry about impact because you're running billions of dollars in a fund, but yeah, it's relatively small at the moment, so it's not something we particularly have to worry about from that perspective. Unless there's things like we can do derivatives. So we have had options in there in the past. We have to be a bit more nuanced around the execution of those. But generally, if we're buying BT, we just put the order in a VWAP and it's fine. Don't have to worry about it too much. Yeah, the point is, from that perspective, like it's just part of the portfolio management process. The flows in and out are just managed, basically.
Yeah, okay. Yeah, fair enough. So then just kind of think how you think about an investment, and given the position that you're in, that investment, might not necessarily be an end product. It could be a manager, or, whatever you're kind of thinking about. I guess, what are you looking for in investment? Is it just that it fits the model, and, the models spout out that you should have X amount invested in this, and therefore you do? Or is there kind of any sort of thought? How does the sort of qualitative thought process go into that? That makes sense.
Yeah, it's very much a top-down kind of process. So it inevitably will look something like, say for equities, we want to be overweight equities because of X, Y, Z. Some of that's going to be the model positioning, some of it's going to be the qualitative judgment. And then within that equities bucket, we're going to have a view on region and style. So do we want growth or value? And again, that's going to be top-down driven. So, in large part in the last couple of years anyway, just driven by the path of real rates. So yeah, again, that's top-down, and then the actual choices will be, the analyst team will have pretty good global equity growth managers they like, and 3 good global equity value managers they like, and they'll have an EFI manager they like, or an Asia ex Japan manager that they'll like, and then it's kind of like that's how it gets built. Or you know, often if we make a change, it'll just get apportioned across the existing portfolio because we don't really want to change the style. So we'll just add one for everyone, or just do it in passive again, like, because bloody hard to be passive last while. So nothing wrong with buying a bit of S&P or a bit of Nasdaq or a bit of Misky World rather than choosing an active manager as well.
Yeah, okay, that makes sense. Yeah, passive's passive been the place to be for a little while at least. So then I guess sort of through, like everyone approaches the market in their own, way, whether it's sort of on a systematic or quantitative or, deep value, whatever it might be. But ultimately we're all kind of chasing returns in one form or another, and you're just sort of approaching the process, doing that in a different way. So I guess when you sort of cut through it all, what do you think the most important factor is in any investment success? Like what's the ultimate driver of returns in your mind?
Luck. I mean, you can't. The best investor in the world is basically, say you're a long only investor, which most people are, like some form of long only, and most mums and dads are long only in the way they invest capital. Like if you retire at 67 or whatever, and you got no prospects of re-entering the workforce, and you just get dumped into a growth exposure, a growth portfolio, which inevitably for pretty much everyone is like 97% equity risk, particularly in sort of super fund land, when you're classifying like unlisted assets as 50-50 growth defensive when they're not. And then you do all that in late 2008 because that's the date you have to retire, and then you just draw down your portfolio 20%. You just have a much worse retirement outcome than you would have if you retired later or earlier. So luck is a huge factor in all of this, and I think you have to be really respectful of that in the way you like. There's 2 ways to describe it, I guess. One is you be respectful of luck because there's so much uncertainty in the world. The other side of that sort of argument is you want to try and build portfolios that are robust to that luck. So I've never been sort of an investor or a portfolio manager that is like, let's lay it all on red. Like I've been doing it so long or long enough to know that like your conviction should never really be high. Like it's super hard to form a high conviction, and if you do have really high conviction about something, it should be super loosely held, because you can get whipsawed by randomness and luck so often. And I think the only real defense you have against that is just trying to build a portfolio that's robust to a whole bunch of wild and different stuff happening. And you can call that diversification, you can call it whatever you want, but it's really important to be aware of that. But also, like, you got to have some view as well, because you don't want to just have a little bit of everything and then think, well, there's some things that you can hopefully tilt the deck in your favor, even if you've got a 55% hit rate, which is probably pretty good from a macro perspective.
Yeah.
If you have that hit rate and you can tilt things in your favor, then you should be adding value as a fund manager or a portfolio manager as well. But just be careful, because 55 isn't very high.
No. So it's refreshing to sort of hear you talk about luck, because a lot of people spend a lot of time sort of trying to convince everyone that everything in returns is from their own brain power. So then I was just sort of thinking back to your earlier comment about COVID and your sort of systematic versus qualitative kind of approach. So you've got your model spits out X, Y, Z. How do you sort of balance that quantitative and qualitative kind of thinking about the portfolio, particularly given luck and world events that pop up from time to time?
I mean, COVID for us is a great example of our process, and because it worked and we added value during COVID, and also how those 2 things come into play. So we like to model it because growth was pretty good. Economic growth was good pre-COVID. momentum was positive, like the policy settings were quite good. All our modelling suggested you should be quite long equities in early 2020, and we were. And the nature of quant signals is they tend to be, well, our quant signals anyway, because of the world we live in, tend to be quite slow moving. If we just followed the model, we would have stayed long through the whole shebang. And it wouldn't have been a very good ride. But basically, that's where the qualitative part of the world, the process kicked in, and that was basically thinking this really looked really bad. Just from you saw the lockdowns in China, saw the data that came out of the China following the lockdowns, and then the escape into Iran and Italy. I remember there was a weekend, and that came out on the news, and then so the team was sort of on chat and email through the day, thinking, well, if it's there, the logical progression of this thing is lockdowns in Europe and the Middle East because it's escaped. And if it's escaped there, it's probably everywhere. Like let's be frank, but we cut risk and we were pretty active to move from overweight to neutral and then underweight in the portfolio during COVID. And that's the sort of qualitative aspect of the process coming to the fore. And I guess that's where you move away from the luck and try and tilt the deck in your favor in terms of how you're managing the portfolios to generate ideally better outcomes, because there was some process and there was thinking around it and there was work done, and we and our clients were lucky in the sense that that was the right decision. That 55 got hit. It wasn't a 45 outcome because maybe it could have fizzed out like Thales one, right? Like it could have just been a whole not a thing, and it turned out to be a really big thing.
Yep.
But we were the process worked, and we kind of got the coin flip right, and those two things working together helped the portfolios.
Yeah. Okay. And then, all right. So, where does your kind of, I guess, your model and stuff, obviously you're looking at various kind of indicators and macro signals and data and that sort of. What's the balance in your business between sort of macro and micro fundamental kind of performance of underlying assets? Are you really just looking at everything from a macro framework, or?
No, well, I mean, you could call the managers micro. Like we do attribution versus the SAAs for the portfolios, and we allocate, like we split that into allocation and selection. It tends to be about 3/4 allocation, 1/4 selection in terms of what we've delivered over that. Which is probably the right mix for us, given we tend to be quite top down. So that's one side of it. In terms of what's driving the process in terms of qualitative and quantitative parts of the modelling, it's normally going to be mostly the quantitative side of things. It's a really good anchor of where you should be absent strong feelings about something being different. It's just been the case that since I've started here at Drummond anyway, it's been a pretty crazy sort of nearly 4 years versus the decade before post GFC, where it was all kind of one way, and the stuff that was going on was it felt big at the time, but it really wasn't relative to global pandemic, a regime change in inflation, geopolitics seemed to go a bit crazy, commodities boom, interest rates rising when no one thought that was even possible. So it's been a bit of a wild time, which means the qualitative side of things has probably been more influenced than it would be in a much more benign environment.
Okay, fair enough. Yeah, it feels like it's been pretty crazy the last sort of 3 or 4 years. That's for sure.
Yeah, I'm hoping. I mean, you were talking about this morning. Just it'd be nice to have just a reset of everything and go back to kind of normal markets. Sick of the volatility, sick of the the uncertainty. It's definitely not an easy time to be a sort of beta harvester, basically.
That's for sure. So, okay, point. So realistically, we might wish for a certain type of market, but realistically, what's your kind of thought process on where we are in the markets at the moment, and what the outlook is, over the next 12 months or so?
Yeah, I mean, we have thought for a while that there would be a recession in the US, and there's been recessions or technical recessions in a whole bunch of places outside the US. There's 2 quarters of decline in the US, but that's not a recession because of the way they do things. But the market response to everything has been, not as simple as we would have hoped, and definitely growth in the US has been stronger than we thought it would be through this process. But that part of that's human nature as well. Like the lags of, the traditional lag, the monetary policy suggests that we should be feeling most of the effects kind of from around the next 6 months. And the big drawdown in 2022 was probably just a head fake. But the nature of having that big drawdown, more, I reckon 20, I call 20 big. So, big drawdown in 2022, plus 2 years of inflation, plus kind of reasonable earnings growth over that period, plus our expectation that we just kind of get another 6 months of sideways-ish movement, means that like the job's kind of done before the recession starts. Like, back in 2022, everyone, including us, putting out notes around, what do equity markets do in a recession? Here's a refresher. In a normal recession, they'll fall 30%. They tick the box there, and you sit and you wait and you twiddle your fingers for someone to declare a recession and equity markets to have fallen 30% and the job done. Obviously, it never works out. Nothing ever works out the way you exactly want it to. Not that anyone would ever want equities to fall 30%, but you know what I mean. So we have effectively, but we've had this really kind of soggy 2 years and probably 3 years by the time all this is over, which means you probably don't get the 30% fall because you've already had some sort of reset, just combination of time and inflation and sideways markets. So basically the view of it is we still wait for economic growth in the US to continue to slow, probably into something that could be called a recession. I don't know, if the unemployment rate goes up 2 percentage points, I'd be happy to call that a recession, albeit a mild one. I don't know if the NBER will, but that's their problem, not mine. I will feel morally victorious if that happens, given I've been writing about it for so long. But I don't see equity markets falling 30% over the 6 months into the lead up to it, but also don't see them rallying another 15, 20% into the lead up to it as well, because they've gone up a lot from the bottom. It's hard to imagine that those sort of tailwinds in terms of just everyone being short because everyone was expecting this was the recession drawdown and everyone chasing each other lower, and a massive sell-off in long rates at the same time repeats itself again in the next 6 months. So you're not going to, basically the view is sideways with vol until there's some sort of resolution to this, which hopefully comes at some point in the middle of next year. Either inflation solved and the Fed can cut rates a little bit, and then we sort of reset, and it turns out it was a mid-cycle soft landing or a mid-cycle slowdown, whatever we want to call it, after the fact. And equity markets continue their probably earnings-driven increase because valuations aren't exactly cheap. Maybe you get some rotation because even though S&P's done quite well, like small caps and EFI and EM, all that stuff just been pretty terrible. So there is value out there from that perspective. But again, it's hard to say that stuff goes up a lot because it's not tech. And after a mid-cycle slowdown, you're probably reverting to a growth scarce world. Like US small caps probably need some sort of outsized cyclical recovery to really post excess gains. Similar to EM, China's probably not going to have that outcome. So let's call it sideways with vol is the outlook for the next 6 months.
Sideways with vol sounds perfect.
Yeah.
All right, so that's been really informative, and you give us some sort of really good background in terms of where you're at and what you're doing day to day at the moment. So let's sort of take a step back a little bit and just kind of have a think about, I guess, your career in totality and everything that you've done over the years. And just for a bit of fun, let's have a bit of a chat about what you think your best and your worst investments are and what you think you learned from them.
Yep. I mean, my best investment, along with probably everyone else, has been Australian residential housing. I bought a house and it's gone up a lot. Although if you think about the world from a liability matching perspective, I just sort of neutralized my liability. I didn't buy extra house. I should have bought extra house. Should have bought extra house in Sydney, and I didn't. I bought single house in Brisbane, which did nothing until it went up 50% in 2 years, because that's the crazy market that we live in. But so that, yeah, from a practical PA perspective, that's definitely the best investment I've made. I think in my investment in my career, if that makes sense, probably been helpful. Like financial services is a good sector to be in if you want to be REM'd well. I chose to do that, not science, so that's probably a good investment as well. But from actually what you want to hear in terms of market-based questions, probably the biggest successful call would have been sort of mid-2010s at QSuper. I was kind of responsible for like US macro forecast, so US economic forecast, and basically took the view that like rates probably weren't going to go back up. That was the time when everyone thought you're going to have a return to normal kind of rates, and looking at the early literature around neutral rates around then, and just soggy growth kind of came, and just work around post financial crisis type recoveries. The view was that it's going to be a pretty slow decade for growth, so you're probably not going to have basically interest rates rising. So the view was that didn't get it right, they were going to just continuously collapse for the next 5 years, but it was sort of a counter consensus call that rates wouldn't go up and probably would be biased towards the downside. So that was good, particularly because that was around the time when they were changing the structure of their portfolios to be more risk balanced. So going back to that bit at the start, that most growth portfolios are sort of 90% equity risk. They decided to go a different way and try and balance the risks of the portfolio, and basically put in a big chunk of high duration bonds to try and offset the equity risk and improve the Sharpe ratio of the portfolio. So similar to like a Bridgewater risk parity type product, but not exactly risk parity. So that certainly supported, I guess, the decision to go down that path, thinking that you weren't about to have a massive sell-off in rates from a tactical perspective. So I think that was I was pretty happy with that. The other one for us in the current role was COVID. Just de-risking the portfolios into COVID was that worked really well, added a lot of value. So they're probably the two I can remember from a positive perspective. From a negative perspective, I mean, prior to buying my house, I was trying to pick some stock. So this is back when I was at QSuper. So I accumulated some savings as people without children do, and decided to put them in the stock market. And there was no process. It was kind of, I think I bought I bought Seek and BHP and CBA and Westpac or something, like just big Australian stocks that I think we had like the old Reuters 2000 or 4000 system there, and I was just trying to pick the ones that it said that brokers had as buy in aggregate. Like, so there was just trying to, in the absence of doing your own research, to copy what the bank thought.
Yeah, okay.
And that was all fine. It's probably, I don't think there was nothing that blew up. There was no small caps or anything. But the problem was I was sort of accumulating this money through sort of 2006, 2007, 2008 as I saved money. And then we bought a house in February 2009. So I had to decumulate all that for the house deposit. So it's basically just market took it all a lot lower and then I had to sell it because I wanted to buy a house. So, I mean, net that wasn't a good idea. But yeah, happy we had a house. Every time I've bought options, I've lost money. And I mean, that's fine because it's generally always been put spread within the context of this is risk hedging in a multi-asset institutional portfolio. But every time we've risk hedged, it's just never really paid off. We've burnt the premium or some part of the premium, which, I mean, that's the outcome for most people who bought options, and net you're happy because the market went up, didn't go down. But definitely that's been a challenging asset class to make money from. And then, probably the other thing was just, sort of around pre-children, 2012, 2013, you know, decided to try and invest tactically via CFDs, basically, and I ended up, I think I square overall, and it was not a lot of money. It was sort of like 10 grand or something, levered maybe 5 times, and then just invested in broad markets. But there was it was around the time of Abenomics, and the Japanese equities were doing incredibly well, and I had some exposure to that, and I think it went up, like from a capital perspective, you know, multiples of capital, because it was geared into that. But then it just went back down again, because I didn't sell at the top. Just basically it went up a lot and went down a lot. So if I'd realized that value at the top rather than letting it go back down, that would have been accretive. But I mean, in the grand scheme of things, it was just not a lot of money, basically.
Yeah. And sometimes you got to go through those sort of experiences to learn from your mistakes.
I think, yeah, the biggest experience for me with doing that, because I didn't do it for too long, but it turned out to just be a distraction, because you'd be watching the market through the day, and because you've got leverage on, you're really keen to not get wiped out by a tail, or a big daily market move, and it's just not what I should be doing as a I've got a day job, which is still investing, but it's not worrying about whether Japanese equities got or down like 4% in a day. That's not that's not my specialty, and it's not what I should be focused on. So, and also you worry overnight about US markets as well. Like you got stops on, like stuck in gap through stops, and it's an additional layer of stress for something that was never really going to lead to a different life outcome for me. I was never going to make it. You know, I'm too conservative to have like enough risk on to actually change my life. So why bother doing it at all? Basically, like, I don't gamble. I've never gambled in my life. I don't have that gene in me. I have a license, but thankfully I don't have that one. And it felt like gambling, and it was just more worrying than not.
Yeah, the stress just wasn't worth the financial outcome, even if it worked, I guess. Yeah, fair enough. Okay, so I appreciate your story about the housing market, because although your shares went down before your first house, I actually did buy my first house right before the GFC, about 6 months before the GFC. So I'm no sort of timing expert either. So then, all right, so someone that's just, coming out of uni, just starting, fumbled into the world of investing and trying to figure out what's going on. Like, what would your advice be for anyone that's just getting into markets, and sort of what's the best place for them to start and find their feet?
I mean, I don't know what's the right answer to this. Invest with it, like, unless you're super passionate about it and have a personal interest in markets and the economy and investing or companies. I mean, for sure, don't try and do it yourself. Like, that would be my advice. Don't pick stocks unless you absolutely love picking stocks and you do it because it's a hobby and a passion, knowing that you're facing on the other side almost certainly people who have way more time to do it, way more resources to do it, way more access than you do to do it. So yeah, do it because you're passionate about it, not because you're expected. You think you're going to beat the market in aggregate. Otherwise, if you don't have that passion, like, just risk profile yourself and invest in some sort of diversified fund that has a risk profile that meets your risk profile. Throw as much money into it as you can and ignore it, ideally. But if you're passionate about it, there's a whole variety of things you can do, I think, to sort of fulfill that passion. So it's not just stock picking, right? Like, that's a big part of the way people think about markets and investing. But the macro side and the multi-asset side, I think, can be quite interesting. But there's also, like, a big part of the domestic industry as well now is around, like, privates, like private markets, private credit, private lending, unlisted real estate, unlisted infrastructure. Like, if you want to do this as your career, that's probably, like, and the objective function was to have an easier time of it, I would be going down the private markets route than try to be like a large cap Aussie equities fund manager, because it feels like from a career perspective, that side of things is quite tapped out. Pretty hard to start up, a new big, fundamental equities manager, but there's a lot of career opportunity in the unlisted side of things, and the appetite from super funds and sovereign wealth funds for those sort of assets, and the money you can get for being a professional investor in those sort of assets is pretty phenomenal.
Yeah, fair comment. In hindsight, we should have all just been property,
Yeah.
Certain
Well, it's funny though,
Australia.
listening to Larry's interview the other day talking about his dad who blew up in the GFC. I mean, the way you structure that stuff means the blow-ups probably aren't as bad as someone who blows up because they lost their job and they can't pay their mortgage. But there's definitely risk involved in that side of things as well.
Yeah, and there's a fair bit of, I think there's an element that a lot of the guys in the private markets don't appreciate. It's been a very favourable backdrop for the past, whatever it is, 10 or 15 years, and there's been a lot of luck that sort of played, tilted the deck their way, that sometimes looked by some. But anyway, look, thanks very much for coming on the shows. Have you got any sort of final thoughts or anything that you wanted to share with anyone that you haven't been able to through the?
No, it's been a pleasure. It's always good to reminisce about life and your career so far. I hope everyone gets together and prays for favourable and easy markets, I guess, from this point forward, to make all our jobs a little bit easier and less stressful.
Yeah.
I mean, it's good. Like, I've got no complaints. I've had a good career. I enjoyed my work. I enjoy the people I work with. I couldn't see myself. The only other thing I could see myself doing would be, brewing beer as a professional brewer or something like that. But maybe one day that'll be the retirement gig. But it's a good life we have doing this sort of thing.
Yeah, absolutely. Well, look, I appreciate it very much. It's been really informative for me, and hopefully people watching get something out of it as well. It's nice to talk to someone that's got some interest in sort of macro and not just sort of individual stocks. As you say, a lot of people are just focused on equity, so it's nice to have a bit of variety in there. If people want to reach out, how can they find out more about Drummond and yourself and the work that they do?
I mean, we're not really retail facing directly, but if you're a financial advisor, definitely hit us up. Drummond Capital Partners, just Google search, you'll find us. Or if you're a wholesale investor, definitely feel free to invest in our unit trust if you meet those criteria and that's a thing that you're interested in. Again, it's just on the website. But yeah, I'm on LinkedIn as well. I'm on Twitter if you can find me, but I'm anon. But if you know what I look like and you're in FinTwit, you can probably join the dots. But yeah, I think the website's probably a good place to start. And also all the stuff we write about, like I write a monthly blog, which I try and make a bit funny sometimes because there's a lot of stuff out there to try and read. So that's all on the website. If you want to jump on the website and have a read of that, and hopefully get a laugh, but also hopefully get an insight into the evolution about thinking and positioning over the last few years.
Great, that's fantastic. Thanks very much. I'll put a link to the website on the comments once this is posted. But yeah, thanks again for coming on the show. It's been really good, and look forward to having a beer sometime.
Yep, sounds good. Cheers.
Cheers, mate. Thank you.